American and to a degree European stock markets are extremely concentrated right now. In the last 100 years, US stock markets were never more concentrated than they are today, where the biggest 10 companies make up 37.7% of the whole value of the S&P 500 index as of today. This is just extreme. Now, everybody knows this huge concentration got worse last year, where the whole year media wouldn't stop talking about Magnificent Seven stocks. But this concentration issue got even worse starting from the current year, which is not something many people know. At the beginning of 2024, the biggest 10 companies made up 34% of the S&P 500 index. Now it is almost 38%, and by the end of this year it could go up above 40%. Imagine only 10 companies being responsible for the 40% of the worth of 500 biggest companies in the United States. That is rare. Now, what risks does this concentration entail, and is it perhaps a precursor to stock market crash? I like putting things in context, so let me do exactly that. This mania around the biggest 7 companies, or Magnificent Seven, started, as this chart shows, shortly after COVID outbreak began. There are few reasons I see why this anomaly was created. It is really interesting to hear many people say it is all AI mania, but is it really? I don't remember people talking about AI all that much in 2020 or 2021. ChatGPT was first presented in November 2022, and that was the point, as this Google Trends chart shows. That was the point from which AI mania really began to gain momentum. Yet by that time, megacaps were already extremely divergent from the rest of the market. So this clearly proves that it didn't have much to do with artificial intelligence in the beginning, but it was more of a consequence of liquidity injections and worries around supply chains or overall resiliency of US economy. Investors correctly predicted that it's those biggest companies that are safest in the given environment and they have the strongest financial position to withstand the pandemic. Then at the beginning of 2022, inflation worries started to pick up, and on this chart you can see that really since January 2022, Google searches for interest rates began to rise. Lo and behold, this was the top, and stocks began to crash the moment people realized Fed will have to significantly hike interest rates and begin quantitative tightening. This is because recession was perceived to be a highly likely outcome of strict monetary policy, as this chart shows, and it naturally spooked equity investors. Thus, this group of 7 biggest stocks crashed by almost half in the given year, but the other parts of the stock markets also declined. Fiscal and monetary policy makers realized that without any interference, this is going to lead to recession and perhaps even worse, to financial instability. Therefore, liquidity programs were revived toward the beginning of 2023, and it successfully reintroduced growth back into economy and financial markets. Its effects are being felt up to this very day. This, however, led to inflation being persistently high. Therefore, fighting inflation was priority number 1 until sovereign bond markets got sloppy in late 2022 and the banking system ran into stability problems in early 2023. From that point on, fighting inflation was no longer the priority. Financial system stability took the driver's seat instead. But as a consequence of liquidity increase, market concentration got out of the hands, and as of now, almost 38% of S&P 500 is made up by only 10 stocks. I didn't want to rely too much on available market concentration data that was often outdated or unreliable, so I did a calculation on stock market concentration myself. There in the left table, you have 10 biggest traded stocks on American stock markets as of the beginning of 2024, starting from Apple with market cap of $2.85 trillion. It used to be the biggest company for a long time now, but this has changed recently, as table on the right shows. As of the end of May, biggest company is now Microsoft. Since Apple didn't really grow this year, its market capitalization remained almost the same due to China iPhone sales issues and lacking innovation in AI. In contrast, Microsoft acquired non-controlling portion of OpenAI in a very strategic move, and it is aggressively integrating large language models in its Windows and Office software products. This got investors really excited, and Microsoft is currently the leader in practically putting AI to work. Now, going back to our tables, you may notice that in the last 6 months, two companies were knocked out of top 10, namely Tesla and United Health, for various reasons. Their places were taken by Broadcom and JP Morgan Chase. Otherwise, the composition of this group of companies remained the same, just the ranking of them slightly changed. What is interesting though is that the total capitalization of this group of stocks grew significantly by more than $3 trillion in the last 6 months. This was most of the growth in S&P 500 capitalization over the same period, so at the beginning of the year, this group of stocks made up 34% of S&P 500, which was capitalized at almost $40 trillion. Now this group of 10 biggest companies make up 37.7% of S&P 500 index, and its capitalization grew significantly by $4.4 trillion. So the rally on stock markets is getting even narrower than in previous year. Now if you consider that Apple grew only by 1% this year, this makes the rally even more concentrated. So the benchmark index Standard & Poor's 500 grew by about 11% year to date, from the beginning of year till today. Excluding top 10 companies, it grew by less than a half of that, specifically by 5% only. In contrast, the group of top 10 stocks grew by 23% collectively. So if you have missed on these biggest names, your returns most probably were not stellar. I double-checked this against the Russell 2000, which grew by less than 3% year to date, and equally weighted S&P 500, which doesn't weight excessively those biggest companies, and it grew also by only 5%, proving my calculations to be on spot. And there you see it, folks, the group of companies used to make up 34% of the index, and now it makes up almost 38%. By the end of this year, it could go above 40%, which is a hugely concentrated market, and it is historically very rare, as this stock market concentration chart shows. The obvious outlier in this group of stocks is Nvidia, which grew by 116% over the given period. If not for Nvidia, the S&P 500 would grow only by 7.6% year to date, and the group of top 10 companies would grow by about the half of what they actually did, so by about 12% instead of 23%. So we know by now that stock markets are historically extremely concentrated, and it is probably caused by high interest rates environment in combination with AI mania. The main question is this dangerous? Should we worry about this? Well, let's take a look. There are a few issues that may come as a result of this narrow rally. First issue is that it doesn't reflect the underlying health of the economy and financial markets. If 40% of the index is made by only 10 companies, it will be a lousy indicator of the state of the bigger part of the economy, which is the other thousands of companies that make up the economy. So while it may sound very optimistic and positive that index S&P 500, which represents more than 80% of US economy, grew by 75% in last 4 years, or about 57% in real terms, in reality most of the companies did not budge. Smaller companies, for example, indexed by Russell 2000, grew only few percentage points in last 4 years, if accounted for inflation. That is just pathetic growth. Healthy economic growth starts with smaller companies, so that doesn't sound exactly healthy to me. Equally weighted index S&P 500 grew in the same period by about 49% after inflation, which is not bad on the other hand. So stock markets don't give you a clear picture of the state of the economy in the current times. Second issue is overvaluation. So the stock market indices are overvalued right now, and this is especially due to the top 10 group of companies. But really, most of the bigger companies seem to be richly valued right now, as this heat map of current PE ratios shows. The red color means companies are currently rather richly valued, and green colors show conservatively valued stocks. So this heat map contains mostly bigger international and prestigious companies, which are in most cases red or overvalued. Especially these technological names, cyclical and real estate companies are richly valued because of expectations of rates going down very soon. These names are seen as safety haven in the current macro conditions, which partly justifies their higher P ratios. Of course, if companies are overvalued, this is risky, because you may be buying them in the state where some of the best scenarios for that given company is already being priced in. So then there is a limited upside for them. And this leads us to the third issue, market vulnerability. Of course, if 40% of the S&P 500 index is made up by only 10 stocks, if those go down for whatever reason, the whole market will take a hit. This is especially bad for those of you who like to invest into passive ETFs that track the indices. Those top names may start declining if, for example, there is some significant geopolitical turbulence, like China severing trade with the United States, or if recession hits the US economy, which would hit the earnings expectations. The healthy way this overconcentration would be resolved would be if the capital flew out of these biggest names to the smaller companies, say in case of soft landing was truly achieved and rates would fall down. But this again would not leave much space to grow for the overall index. In such case, equally weighted index or index of smaller companies such as Russell 2000 would be a better choice. Nevertheless, if true recession hits, the big companies could easily fall at these multiples by 20 to 40%. The rest of the market would also go down, and this would be really ugly for the overall index. So taking the middle path, there seems to be a limited room to growth for the overall index if you invest at the current prices. And fourth issue is that historically high concentration tends to correlate with generous valuations and with 30-year stock market cycles. This chart was analyzed in detail in one of my previous videos, which you can check out via this link, where I went through the possibility of us being in the second part of 30-year stock market cycle, which is usually synonymous with the lost decade. So the blue line shows Shiller P ratio, where I noticed that there are these 30-year cycles as marked by red vertical lines. In each cycle of the last 100 years, first half was very positive for equity investors with average of 450% of real return. However, the second half of the cycle was turbulent, and from the top to bottom it usually halved your initial investment in real terms over the decade, thus the lost decade. I don't want to scare anybody, so do note that if you did not invest on the very top and sell on the very bottom, your equity returns would surely be much better than that. But importantly, in orange line, I marked the approximate path of stock market concentration. So in almost all cases in the last 100 years, it correlates pretty strongly with the overall index valuation. So when S&P 500 valuations go up, so does the concentration. When the concentration falls, so does the overall S&P 500 valuation. This is an issue because it may prove to be a topping process, which when completed could lead to a lost decade or lousy returns to follow, especially for passive index investors. But beware, the top of the market may still yet to come. So I'm not calling for the top here. And by the way, Shiller P is higher now, being at around 34. This chart is a bit older. Using some basic technical analysis, if it doesn't go above the tops of 2021, it may form lower highs, lower lows trend. Or if it tries to attack that 2021 level of 38.6, it may face a big resistance, and those are the risk factors that you must consider. In conclusion, American stock markets are now concentrated in a way no living person on this planet saw in his entire lifetime. This was a blessing on its way up. It made many people rich, I'm sure of that. However, this comes with its own set of risks, which should be considered. Historically, high valuations and high concentration was not the best time to be a buyer of equity. However, I do not pretend I know whether we have reached the top or we have few years to go until we reach that point. And again, I don't want to fearmonger with this analysis. The right portfolio management considers both sides, good and the bad. So do consider the optimistic part also, because remember, markets generally go up over time, not down. Do not forget to diversify your portfolio and never allocate 100% of your capital in the direction of your highest conviction.